week when we touch base with a new fund manager and get a sense of some mutual funds in the domestic market which are drawing interest from investors. Vetri Subramaniam, CIO Religare Invesco Mutual Fund, joins us on the show to discuss Religare Invesco Contra and Religare Invesco Infra Fund. Good to have you on the show, Vetri. Are you seeing more redemption pressure or inflows into the infra fund right now? I mean, given the supernormal returns that the sector has witnessed this year, what's the call that you're taking on managing this fund?
Certainly the theme of the last 5 years has disappointed, I think, the way way it has played out. But unfortunately, last year when the fund was, pretty much at a cyclical low in terms of its price, we were actually seeing a lot more redemption pressure. In recent days and weeks, if anything, we've actually seen the redemption pressure abate, and if anything, we've actually seen some fresh subscriptions as well start up into the fund. So, the sentiment has changed, and that's resulted in a change in fund flows as well.
Which are your preferred investment ideas then for the sector? I mean, you have power producers, road project builders, distributors, financiers. What is it that you're focusing on as far as, the infra play?
Right. So, our focus, as it would suggest in an infrastructure fund, is, on companies which are more core to the infrastructure fund, and therefore, we have some investment in companies which are in the financials, etc. But it's very, very limited in our portfolio because we like to keep it focused on companies which are either involved in helping build infrastructure or which are owners of infrastructure. In our portfolio, honestly, you'll find that the exposure to some of the areas that you mentioned, like roads, power, etc., it's certainly there. But I would say, again, it's dominated more by exposure to what we would call product companies, because these companies are not balance sheet intensive companies. Certainly they have faced pressure on their profit and loss account because revenue growth has not been there in recent years because of slow infrastructure build out. But they've been able to handle that pressure because their balance sheet was very, very strong. On the other hand, in areas like power, roads, etc., we've had grave concerns about the health and quality of balance sheets, and therefore, while we do have exposure in companies like a power grid, which is a regulated utility, we've been very cautious about taking exposure to non-regulated entities in these areas. The one sort of capital intensive area, though not at the same scale to which we've had exposure, and it's proved profitable to us, is companies which are in the ports and logistics space. But again, over here, they've not been affected by issues such as fuel delays, environmental delays, and therefore projects have not suffered from delays, so to speak. So that's been our preferred sort of capital intensive area for investment.
How do you de-risk a high beta portfolio like this one?
Honestly, in that sense, we can never de-risk an infrastructure fund from its core objective, which is to invest in companies which are focused on capitalizing on that infrastructure opportunity. But I think what has worked well for us, and it is in some senses a de-risking strategy over the last few years, has been the fact that we've been very focused on the return on equity profile and the return on capital profile of our companies. So our portfolio, even during a difficult year like last year, had a weighted average ROE profile of almost about 16%. So I think the only way you can de-risk a portfolio like an infrastructure portfolio is not by diversifying into areas which are not core to the infrastructure theme, but by making sure you are invested in companies which can handle the difficult times. Not that they will be unscathed, but at least they will be around to benefit from a cyclical upturn and from an investment cycle upturn whenever it happens. So really the only way to de-risk it is by making sure your stock picking is good rather than by any other methodology.
And tell us, Vetri, what's your fund strategy with this portfolio as most of the market has moved up? Can one benefit with a Contra theme?
Really what the Contra fund is, it means that the fund has a very clear focus. It has a very clear bias towards a value-oriented investing style. But value investing as a style, as a concept, is something which has got fantastic track records over a long period of time. And if you just look at our own fund as an example, over the last 5 years, on average, we've created, if you look at the CAGR returns, we've created almost about 4 to 5% of alpha per annum. And even if you look over the last 6 years, calendar years. We've beaten the index in 4 years out of 6 years, and these include both up years and down years. So really the way to look at the Contra fund is that it is dominated by a value-oriented investment theme. There are certain phases of the market where its performance can be spectacular compared to the benchmark, and there are phases where it may struggle relatively more to outperform. But I think over a whole cycle for the economy and for markets, really this is a strategy that I would say is timeless, and it has place in every portfolio, irrespective of the phase or mood of the markets.
Which are your top Contra theme ideas then among mid-caps at this point in time, Vetri?
So, in this portfolio, our biggest bet going back to about 7 or 8, maybe almost a year, has actually been in the industrial space, because that is where we saw a lot of value in terms of companies trading very cheap, not just on earnings, but also relative to underlying book value. So that had been our biggest bet almost a year ago. But honestly, in recent times, we've been paring back on that bet because valuations in industrials have moved up very dramatically over the last 12 months. So we've been paring back on exposures in that area and sort of moving the portfolio to other areas. Where have we moved some of that exposure to? For example, we've moved some of the industrial exposure into the media sector. Why into media? Because again, this is a sector which has fantastic operating leverage. Their cost structure doesn't change too much, but when the economy enters an upturn, they see a lot more revenue come through by advertising, and that tends to flow straight through to bottom line. So they are leveraged to a cyclical recovery, but their valuations have not moved up as dramatically as it has for industrial companies. So that's one area of the market which we have favored quite a bit in, I would say, recent weeks and months.
And finally, Vetri, how do you balance the portfolio to generate alpha between different market caps?
Again, fantastic question. We tend to move around between these different parts of the market based on market cap, based on where we think the greatest opportunity and the greatest safety lies. If you go back to about 2011, 2012, the portfolio was very large cap dominated at that point of time because we were concerned about the health of the economy. Over the last, I would say 1.5 years, on the other hand, we've been fully positioned in mid caps. This was a very painful bet in the middle of last year when mid caps actually did very poorly, but we held our conviction in that space, and it's seen a fantastic outperformance because of our mid-cap bias. So in that sense, I would say that is a strategic and a tactical call, largely based on where we think the valuation opportunity lies. At this point of time, our portfolio still has a significant mid-cap bias for two reasons. We think mid-caps are far more sensitive to an improvement in the economy. At some point over the next 12 months, we think monetary policy will become more benign. Again, we think mid-caps are bigger beneficiaries from this. And finally, mid-caps in general tend to be much more domestically driven in terms of their business profile as compared to some of our large-cap companies which now have a global footprint. So because of this, we still have a significant mid-cap bias in the portfolio.
Thanks for that, Vetri. Thanks for joining.